Welcome to the InsideTechnician.com. I am Jeff Killian, Chief Market Strategist, and it is now 11:48 a.m. on December 11th, 2014. Today's brief presentation is a demonstration on how to identify with a market turning point, in this case to the downside most recently, that is in process as we speak. Now, the current state of the U.S. markets, according to the E-mini near contract month of 12/2014, has recently gotten out of market net neutral here and has now begun to trade short. Although the current prices are trading at 2053.50, that's 2053.50 marked to the market, the overall bias is for prices to continue to trade to the downside on a daily basis. As we look at the prices that have trended to the upside and formed the market net neutral trading channel between 2076 and 2047, it is clear that the absolute floor level to get traded through was 2047. That again is 2047 within this market. As we take a look at the money flow indicator, which is a clear and concise and extremely accurate representation of what the largest institutions, the largest hedge funds are in fact doing behind the prices here, you'll see that the bias was to the downside. In this case, looking at an upsloping trend line established by this data point and blown up to this data point here, we have the negative divergence that's officially established within the indicator's peaks here as compared to the prices, illustrating once again pent-up selling pressure that had not yet taken place yet in the form of the down move that came within the past two closed out trading days. That was more than evident all the way back here at this point. And again, clearly the momentum increasing to the downside for the probe that came through and the continued momentum to the downside now with the official floor established, where I previously demonstrated on the daily chart with the volume and the subgraph to get through and to be short. Now, it isn't uncommon for prices to correct back to the upside, a daily short-term correction to the upside within a newly established and existing, very beginning downtrend. This is normal price behavior. In this case, it's clear to see the relative comparison of the short-term money backed by the institutions that we're referring to here is to the downside. A longer-term perspective on the Chaikin money flow 21 period indicates a long-term negative divergence as compared to prices, once again illustrating the pent-up selling pressure that had not yet taken place in form of the downward movement that came to be right here. Now, this is the very beginning, and we need to understand as this unfolds, prices may find various levels, go net neutral, have a correction to the upside. By and large, the trend should continue to the downside with this much pent-up selling pressure. I believe at this time, based on what we're looking at, there is still more room to go to the downside. And all the indicators that we're looking through here, as the Chaikin oscillator as well, clearly depicts, after another negative divergence, that the momentum is still to the downside, even though prices are trading up today. Now MTM at 2054.50. Outside of that, looking at the MACD indicator, it's clear this trend changed direction right here when the cross was absolute. Disparity, aka the difference between the MACD and the signal line, has widened considerably, and it exists marked to the market as we speak, trading 2054.25, even though prices are up. More often than not, traders, what we'll see here is the market has traded up substantially, and that you have a lot of people, average investors, who believe there's still an opportunity to be long and will come in and buy into selling pressure because they believe that the market can keep moving to the upside. The evidence that we're seeing here does not suggest that it is a strong possibility. Now, let's remember, in trading, there is no 100%. We need to deal with the law of probabilities. And right now, everything that we're looking at clearly states that the market turning point had officially been identified with, established, and traded short by almost everyone who's been through the system here. The simple but precise application of a trend line here would have given you the early confirmation out of the pattern to the downside on the down close that there were higher probabilities that prices could move to the downside. Again, an intersection between the upslope trend line and the absolute floor level, once again, that was established at 2047, would have left anybody who was serious about trading in real time as a professional with this 2047 laid out on the 15-minute charts, extrapolated from the 1-minute level and waiting for prices to get through that with an end target all the way down to 20, 25, 75, which is exactly where the prices went to. Now, these levels have been laid out for weeks. And so therefore, anytime we're looking at a market correction in play, additional levels will need to be laid out as prices may continue to trade to the downside. These are obviously used as long-term price profit targets with a big point spread, in this case between 2047 and 2025. What to look for? Let's look for the continued momentum to the downside on the indicators. Let's look for the additional reducing days as against this bar's open here. And let's look for prices to retrace back to the downside and eventually get through 2025-75. Once again, we're dealing with high probability market turning points, and after those are identified, every trader who's been trading even a short period of time fully realizes that this is where we make the lion's share of our money, a lot of cash in the account in a short period of time. The holiday season is upon us, and our expert market timing course will be offered to everyone within our database at a very special price. So please refer to the email that this video is included with in order to take advantage of that and learn how to catch these market turning points as a true professional does. We have over 100 real-time trades taken in our primary market, the E-mini futures, posted to the YouTube channel, and many as well on the blog, on the company blog within the website. These are there for a reason. We do this so we can present over to you, the world, in a fully transparent environment, in the moment, what we did, where we did it, and how we profited from it. We do this so that we can show you that our education is the right education at the right time for the serious trader. If you are the serious trader, take advantage of this course now and use this as the foundation for the future of your real-time profitable trading. We'll see you on the next high probability trade setup and the new year to come on all of our profitable trading here at the Inside Technician.